Hello, you're listening to Better Financial Futures. I'm your host, Shaun Boatman. After 3 decades in financial advice, I've seen how small, informed decisions can transform someone's life. This podcast is my way of sharing that experience so that one listener can take a step towards a better financial future. Now, today we're joined by a good friend of mine, Shaun Bartle. I've known him for many, many years, I think over 10 years at least. And he's a little bit younger than me, but he's a very knowledgeable guy and really successful in various different fields. Shaun, welcome to the podcast. Thank you for coming on.
No, good to be here. I'm looking forward to this.
Tell us a little bit more about yourself, your background, both professionally and personally, and your relationship with money.
Yeah, okay. So I'm a qualified accountant by background originally, but please bear with me, guys. I assure you I'm fun and I do have a personality. So I started my career in industry. I was very determined to work my way up that corporate ladder because, like many people, when you're young, you're told that the way to create success in life is to go to school and do well, go to college, potentially university, and go and get that job and work your way up the ladder. And so I was very ambitious. I was working my way up the corporate ladder. I was finance manager of a £3.6 billion international trade finance firm at the age of 23. So that was quite entertaining. Lots of pressure there. And that was a real eye opener into the big wide world and just how money does really operate. So that was a great sort of first intake on that. I've naturally transitioned over my career into operations, sales, and covering a whole bunch of areas as well as property investment. But ultimately, at the core of all of this, money has played an integral part. And to answer your question about my relationship with money, it's a great question. I always ask people this. What's the first word that you think of when I ask you, what is your relationship with money? For most people, it's anxious, it's anxiety, it's fear. For myself, I really use it as a tool. So the relationship that I have with it is that it is part of my arsenal on the journey of the ladder that I'm going up.
Now, I don't know if there was a slip of your tongue there, but I think you mentioned my football team, which I know we have a rivalry there as you're a Chelsea fan.
We do.
But thank you for mentioning Arsenal. That's very kind of you. Money is something that sometimes people don't like talking about. Did you learn about money at school?
No, not at all. You don't learn any of this stuff at school. What's really interesting is that because of my background as an accountant, most people make the assumption that that's where I gained my knowledge on money in terms of the history of money, how money really operates in society. And to be honest, that's not true either. You learn about where it goes on a balance sheet, cash flow statements, and those sort of nuances, but you don't really learn about what money is, how it can help you with your business, your personal journey. You don't learn this stuff. To be honest, it's all self-taught and studying history for myself.
The subject of money, especially in the UK, and we will have people listening, watching this from different parts of the world, but it feels like in the UK, it can sometimes be a bit taboo, talking about money, especially amongst friends and family members, maybe. How do you feel about that?
I couldn't agree more. It really is a taboo word. And unfortunately, the negative side of that is that if you're in a bad situation, you don't understand how these things work. A lot of people keep that closed in. And then they can end up going down a very dark path where they can end up racking up debt, not understanding the consequences of decisions, and end up just spiraling out of control. And unfortunately, this happens more often than not. So I couldn't agree more with your statement on that.
Yeah, I think, I've got a sign behind me, knowledge is power. And if you take some small steps to actually understand this information and this subject, you can apply that knowledge. I know you've got a lot of knowledge on the history of money, and how do we end up with, physical paper that was, is money? Back in the day, we had a barter system, didn't we? Just explain to people where that came from, what that was all about.
Yeah, so the origins of it with the barter, for instance, the simplest example of this is, let's say that I was a farmer, because particularly in the UK, we had massive agriculture, right, back in the day. I would have 10 sheep, and John, you're the other farmer down the road, and you've got 1 cow that I want. We would exchange. You get the 10 sheep, I get your 1 cow, and we feel like, okay, this barter system has worked. You feel you've got a good deal, I feel I've got a good deal. And then we would go our own way from there. And that's really the simplest form of the barter system. And over time, so many things have played a part of that. Historically, there were certain islands that were found, and they had very rare stones. And these rare stones and gems were used on that island. And then all of a sudden, Europeans would come over and they would have something completely different that would dilute it and completely change the whole way that this island would work from an economic perspective. So it has shifted over time. There's been many different instruments that have played the role of money over time. And I think that the most recent that people can relate to would be the gold standard. The money was backed by a physical item, in this case being gold. So I'm sure that many of the listeners have heard the expression, it's as good as gold. This is where that expression comes from, right? Is because gold had value because of the properties of it, right? It's fairly finite. It's hard to get out. You can't just go and create more of it very easily. You can't just push a button and suddenly we have more gold. There was a lot of labor, time and effort that would go into procuring it. And because it was there, it was backed, it had value, and therefore people did feel that their money was safe if it was backed by gold. And you did at one point, you had banks that would have physical gold in their vaults, and then the paper element of it, which was the next extension of it, was backed by it. So the US dollar used to say on it about being backed by gold. It certainly doesn't say that now.
No, so I mean, I can't imagine us walking around with a bag of gold each. That's
No,
so
dangerous.
that change, if I'm right in saying that change in the 70s, didn't they? Just explain what happened and how we ended up with what we know as money now.
Yeah. So you're right. It was the 70s. It was August 1971. We had the Nixon effect. So President Nixon of the United States basically took the US dollar off of the gold standard, which meant that it was no longer backed by gold. And what's really interesting about this is that I know people that have gone to university and done a banking and finance degree in the sort of 2010 period, after 3 years of university, didn't realize that it still wasn't backed by gold. So this sort of links in with what you said earlier about financial education. We're talking about people that have spent considerable money to go to university in banking and finance and still didn't know that that was the case. So as we moved off of the gold standard, this meant that in reality, and this can get quite dark, there was nothing backing it physically. So you then have to ask the question, well, what does back money now? And in my opinion, as draconian as this sounds, it's backed by the fear of violence. Because with the US, for instance, it's their military that's backing the money. It's that fear of violence that they can go in and do whatever they want because they currently have the money, right? So it can get very dark when you talk about this, the history of money. And the rise and fall of empires throughout time has been the same. The Roman Empire, the Greek Empire, all of these empires fell when people started to mess with the money.
Yeah, I think I mean trust comes into this, doesn't it? And what makes a £10 or a $10 piece of paper that says £10 or $10 is because we all as the people accept that this piece of paper is valued at £10. Now, obviously, one of the disadvantages is I know that we could get political, but we're not going to get political.
I will avoid that.
The central banks, they just print more money, don't they? So what does this do to our currencies around the world?
Yeah, so we need to think about this with the ease of just printing money at will. And what you have to think about is that you are then expanding the supply of something. Now, if there's more of something, typically that means it's less valuable. And we have to think about the inverse of this as well. The rarer that something is, the less supply of it typically means it's more valuable. So a good example to explain how this works in reality is if you can imagine that there's a finite amount of known Picasso paintings out there, famous artists, the paintings are worth, X amount because they're rare. But let's, for example, say that all of a sudden there was some dungeon in a castle that we found and there was 1,000 more legitimate Picasso paintings that were found. Well, the first thing that happens is that those existing ones that were known about will decrease in value straight away. And the reason for that is because we've just added more supply of Picasso paintings. So there's now more of them, which means it's not as rare. Now, if we use that analogy to think about the money supply, the exact same principles apply to it. If we just keep printing more money and adding to the supply, how can it possibly be worth the same amount it was before you added more to it? And it's that's in its simplest form, that is how it works. It's a lot more complicated in terms of where the money is created and how it funnels down. But in the simplest form for everyone to understand at a very basic level, that is how it works.
We're in a world now where people borrow money, they save money, they sometimes avoid saving money, they go into debt, borrowing money. So just moving away slightly from the supply of money, we're in a society now where, especially the younger generation, they don't actually see the physical money. We've got to a point now where we're tapping devices and we're not seeing maybe the value of money. So just touching on your children, the younger people around you, how do you educate the younger generation about money?
So for me, with my son, he's 8 years old. And what I do is, first of all, we got him into Monopoly at a very young age. And that's because it's fun. But what you can do is you can drop little lessons in there as you go throughout. So over time, he's built up the mindset of he just wants to buy every property he lands on, because he knows if he does and someone lands on it, they have to pay him money. Whereas when most of us were kids, if we're brutally honest, we only cared about 2 properties on that whole board. Right? And that was Park Lane and Mayfair, because it was the big expensive one. So little things like that you can do as a parent where it makes it fun, especially when they're younger. But also take it upon yourself to educate them on money. So I'm a big fan, and this isn't financial advice, but I'm a big fan of physical gold and silver. I love it. And I have a small amount that I keep at home. And I've brought my son up to teach him what that is versus the £10 note in the wallet. And every now and again, he'll say to me, "Dad, can we look at the real money?" And what he means by that is, can we go and get the gold and silver and just have a look? And I've got pictures and videos of him lining it up. And I think there was one particular case where he said, "Dad, we need more gold." So I had to explain there's a big price difference between gold and silver. But you can make it fun in any way that you want. And there's also some great apps out there. Again, it's not a recommendation, but something I've done with my son is get the Go Henry. Because there's the parent side of the app, then there's the children's side of the app, and there's actually lessons on there that they can go through, and they have to complete the lesson to unlock the next one. And you could just, as simple as saying, "Listen, if you get the first 3 lessons done, I'll transfer £5 over to your account." And so you can teach them these ways where they're learning on an actual platform about it, but you're also teaching them to earn it and value it, and it doesn't just come easy.
Yeah, I think it's really important for all generations, the older and the younger. And obviously, as we're recording this in February 2026, gold and silver have had quite a good year of increasing values, because I suppose because of the political situation. And again, this isn't advice, but understanding that and understanding you can buy gold and silver coins and maybe keep that as a store of value for later. It's something you can do. And I think for me, it's a really interesting subject when you realize where money's come from, and maybe we're not in a better situation than we were back at before 71, like you mentioned. And, the value of our money is decreasing. So, I've seen in my life as a financial advisor, I've seen lots of people feel a mistrust in areas where they could invest an opportunity, and they stick with maybe a retail high street bank. So I just wanted to touch on interest rates. So we've got money, say we're trying to save some money. One of our episodes, we talked about looking at our subscriptions and seeing if we could cancel subscriptions, which then frees up some money to maybe look at investing. So, bank accounts and interest rate, just, why do people have bank accounts, and what is, just in basic terms, what's an interest rate on that? But some people don't understand that. So just to kind of help people with that.
Yeah, so if you've got a bank account, you typically would have your current account, which is your in and out money, and then you potentially have a savings account. Now, normally with the savings account, you will get a rate that's given where if you keep your money in there, the bank will pay you interest on that. So you can earn money on your money. But what happens is that as there's changes in the interest rate set by the Bank of England, we then typically see a change and a shift in the rates that are offered on savings. So as the interest rates make debt cheaper, the bank saving rates also decrease. So you then have to take a wider picture and think, well, who benefits from this? And it's those that own assets. So if you look at property investors, they will benefit because inflation is actually going to cause their asset, typically speaking, the exception doesn't disprove the rule, but typically speaking, the asset's going to go up in value. And with interest rates, if they're coming down, it means that access to debt is cheaper. And you have to be very careful with this because it's very easy for banks to just say, recently we've seen stuff about 98% mortgages. This is very scary territory, but to the masses, if you don't understand how money works, that could sound very attractive. Hang on, I only need 2%, I can go and buy a house. Yeah, well, it's not quite as simple as that. We have to think about what's going to happen in the wider picture. 5 years' time when the fixed rate is up, for instance, what position could you be in? Is there a potential negative equity, particularly if you do things like buying a new home? So there's a whole sort of widespread that you have to factor in. And when it comes down to this stuff, you really have to factor in your own risk appetite. Because a lot of people say cash is king. And if you do just have cash sitting in a bank account, well, first of all, well done for saving up, right? Because most people can't do that. But you have to think about the wider picture that if inflation, and again, it depends how deep we want to go on inflation, but inflation is going to be at X%. Your bank rate's going to be at Y%. And then the difference, almost like arbitrage, is that's your net position. But then if you want to go down the rabbit hole, you have to then question, well, is the inflation figure that's reported true and fair? And this isn't to be, conspiracy theories. There's public data out there on this. You just have to do your own homework. But since they've started recording and comparing inflation on a year-by-year basis, what we have to understand is that basket of goods that is compared, and so for the benefit of everyone, what I'm talking about is that a literal basket of goods from a supermarket, for example, where you've got an apple, toothpaste, you've got these general items where the price is monitored year on year. What happens is that if there is a huge spike in a particular item, it can be removed and replaced with something similar. But you then have to question that because, no pun intended, you're no longer comparing apples and apples. And so it's then about, well, actually, is inflation really the figure that we've seen over the past few years? Think about your fuel bills, the cost of your food shop. How much has that gone up? Then you have to factor in your income. Are you getting a 5% pay rise? But if inflation was a 7% in the year, you're -2. So there's a whole variety of things that people have to factor in.
Yeah, there was a lot of information there. So just going back a few steps. So first of all, 98% mortgage is what you're referring to. So you would be borrowing 98% of the value of your house. So with only a 2% deposit of the value of that house. And the risk of that is if the value of the house went down, then you're in what's called negative equity, just to be clear what that is. Interest rates. So typically interest rates in the UK, or in a bank account are historically very low, maybe 2%, 3%, that kind of area. And then you touched on inflation, and I know you explained it with the basket of goods. So, we understand inflation well, but for kind of an easier way of understanding it. So it's really about, what did it cost in 2024 to buy a bottle of milk, let's say, or a carton of milk? And what does it cost now? Or what did it cost to buy a bar of chocolate 2 years ago compared to now? And that increase in cost is inflation, basically, in simple terms. And obviously what's affecting that is the products that go into milk, farming, and chocolate and the way and the supply chain. So inflation can be higher than the interest rate that you're receiving on your bank account savings, which is why people look to go into traditional investments. Maybe is that a kind of fair explanation of
Yeah,
of what we do?
absolutely. And another way to think about inflation is you have to look at what did £100 get you last year versus what does £100 get you right now. And there will be a difference. So even though the account would, in this example, still say £100, it will get you less now than it would have last year. And that's the mindset to think about how this works.
Yeah, I do seem to open a packet of crisps every year, and it feels like there's less crisps in the
Yeah,
packet, but the
yeah,
price of the crisps is higher. So
yeah.
I don't know if that's inflation or just
A
I don't know
mixture
what
of
that.
everything, right? Freddo's always a great one that people use as an example. I mean, when I was a kid, it was 10p. It's probably like 65p now. So he's obviously grown up with me and got kids and a mortgage because it's more expensive now to buy a Freddo.
Now, just going back to the money conversation again with digital money. So now, as I said before, we don't necessarily see the physical $10, £10, €10 note. We're seeing the rise of contactless payments, but we're also seeing digital money. Now, there's different ways we can explain digital money. Just from your experience, give us a bit of information and knowledge about that area.
Yeah, I mean, the physical cash element is definitely dying out. And there's huge amounts of stuff on this. And again, we won't get political. That's a different discussion. But you know, some businesses want cash. But as we're heading to a cashless society, you then have to question, well, if everything's digital, what impact will that have? Some businesses are going to have to change their pricing structure and everything like that because when you use digital, there's always a cost to it. Nothing's free. So every time that there is a transaction that's done, there is a cost to the vendor for that. Whereas if it's cash person to person, there isn't a cost of that transaction, so to speak. So that's definitely evolving. And as technology advances so quickly, we have the opposite side of inflation, which is deflation. Now, I won't go too in depth on that, but essentially what we're saying is that technology does make things a lot quicker and more efficient. And therefore, do you need to spend as much labor on it? And it is literally the opposite of inflation. So exactly how we described inflation, deflation is the opposite. And you have these forces sometimes competing. And as technology advances, we could see that deflation accelerates more where inflation could slow down. But there's so many variables at play there that we could spend 2 days on it and still not have the right answer.
Yeah, I mean, going back to Monopoly and playing Monopoly, I think it's a great way of understanding how we can look to invest in assets to produce income rather than just continually exchanging our time and our skills within a job environment. So, I know there's a book that has been already mentioned on our podcast that you read at a very young age. Do you want to talk a little bit more about this particular book that I know we both like?
Yeah, Rich Dad Poor Dad's kind of the OG of the books in this space on that, and it's had a big impact on a lot of people. I read it when I was year 10, 11, secondary school. I used to read all the Dragon's Den biographies and stuff, and then come across this one as well and read that. And it just gets you thinking about the relationship with money, how people view money, how money operates. And again, it's the stuff that you don't learn in school. So the more exposure you can give yourself to this type of content, where you actually sit back and not just read it and consume it, but actually reflect on it and make sure you're taking it in, you'll be able to put yourself ahead in terms of understanding it.
Yeah, I think, and by the way, I've got no vested interest in mentioning the Rich Dad Poor Dad book. Not on a commission or anything like that. The author is Robert Kiyosaki, and it's an incredible book. It can get a bit technical, but there's some good stuff there. Just going back to the schooling system or the school system, I know that they're bringing in financial education to the syllabus next year. This is what we're trying to do with this podcast. But what can we do to help people understand more about money, within the school system? But does that always rely on the children and the teachers? I mean, what's your feeling on that?
Personally, I think that parents also have to be accountable here. And again, we won't go down a rabbit hole, but it's your duty, in my opinion, to teach your children about financial education because it's going to impact them at some point. I mean, it already is impacting them in terms of your situation as the parent. Do you want your children seeing that actually at the end of every month, you start to panic about money and they're hearing conversations that could be negative because all we're doing is just seeding them to then have a potentially negative relationship with money without understanding why. So the education side's really important. And this doesn't mean you have to be a scholar in money, but just the basics, get those right, understand how it operates so that you can then teach it to your child in a fair way that you can also try and make it fun, like I explained earlier.
Yeah. I think also just quickly comes to mind that, we're in February of 2026 and people have come off Christmas. Maybe they've overspent, maybe they've got some debt and they're really anxious about that. Many years ago in the 90s, you probably weren't even born then, but anyway, I had credit card debt and it created a lot of anxiety. Is there any tip you would give somebody, not just on the knowledge of money, but what they could do in the short term? They may be in a situation where they haven't got savings and they're really going from month to month.
Yeah, one thing is to look at your income. Now, this doesn't get spoken about enough, but are you maximizing your income? In other words, when did you last, if you're employed, for instance, when did you last have a pay review? When did you last look at the market to see actually, are you getting what you're worth? So that's point number one. I'm not advocating everyone goes and resigns and gets a new job. But again, it's just little steps like this. Like, are you being paid what you're worth? Are you able to potentially do something as let's call it a side hustle, where you're creating other income? There's lots of things out there like this. There's network marketing, all of these types of things where you can do other stuff that's not going to cause you too much pain in terms of time, but you can bring in other income. And then you need to look at, if you do have debt, is okay, what debt has the highest interest rate on it? Because that means it's the most expensive debt. So in my opinion, you want to be clearing that first, even if it's the most expensive or even if it's the smallest amount of debt and the smallest amount of monthly payment, clear it first because it's still the highest amount of debt in terms of the percentage. And then just be disciplined in sticking with your plan. You have to pay the price now and sacrifice something. So instead of spending money on takeaways, instead of spending money in the January sale and getting a whole new wardrobe of clothes, is use that excess money and pay down the highest amount rate of debt that you have so that you can get things cleared quicker. Discipline doesn't get spoken about enough. And for me, it's one of the key components to actually life in general. The more disciplined you are, the better situation you can create for yourself.
I think also one of the things for me in the financial advising space, and this is not financial advice because everyone's situation is different, is sometimes even if the interest rate is slightly lower than the highest one, but the debt is smaller. So let's say you've got a smaller credit card debt, but the interest rate is not as high as a greater amount. Sometimes psychologically, it's good to be able to clear one of the smaller debts because it feels like an achievement that you've cleared that debt quickly. So I think it works in different ways. So we're coming to the end of this recording, and Shaun, it's been really interesting talking to you. It can get quite technical money, but I think just understanding a little bit, and I hope people have just picked up one or two things that can really help them, whether that's to do with the interest rate they're getting on their savings, maybe it's to pay off some debt. To understand the history of money is just incredible, I think. And it's amazing that it's not being taught even in university degrees. So my recurring question that we ask our guests is, what's your biggest financial mistake that you've made in your career, in your life?
I
said I'd put you on the spot, and
you
now
did. And I
yeah.
wanted to think of the answers to give the best benefit to the audience as well, rather than just spitting something out. In all honesty, when I was younger, but working in London, I was very guilty of the keeping up with the Joneses mentality. And this is definitely something that happens a lot in London for sure. And I grew up in Essex, don't live there now. And that genuinely, there is this mentality of looking the part, living the lifestyle and stuff. And I was very guilty of that in my early 20s, which meant that I made some very poor decisions in terms of taking debt out for things that I weren't going to get a return on. So I would say that, and that was a hard lesson to learn, but it was a good lesson to learn.
Yeah, so you're having a good time. You look smart and kind of really cool, but you didn't have any money.
Exactly. And unfortunately, it's a trap that many people fall into. And my advice on that is just don't do it. It's just, be disciplined and don't do it.
Yeah, and you don't have to go out every night, do you?
No, again, that's another lesson that I learned the hard way back then.
Thank you so much for coming on. You've offered great value here, and I hope many people listen back and hear what you said, because it's so, so important. So thanks again, Shaun, for coming on, and we'll catch up soon, all right?
It's been a pleasure.
So my top tip for this episode is look at your credit cards. If you're holding credit card debt, really focus on where you might be able to save to then start increasing the payments on your credit card. I've been in credit card debt. Back in the 90s, I lost my job 3 times, was made redundant, had credit card debt. It's not nice. And my top tip is to clear your credit card as soon as you can. Look at where you could make some savings, but also look at the interest rates that you're being charged on the credit card. Hope that helps.